our small business funding webinar. We got a good one for you today. And as everyone's getting on the line, I always like to start out by giving a big shout out to our chamber partners who are helping us share this broadcast on Facebook. So big shout out to the chambers of Laverne, San Dimas, Azusa, and Pomona. Big shout out because you guys are awesome. And I can't wait to share these great resources with our local small businesses. As we're getting started, you may be asking yourself, what is the Small Business Development Center program? And in a nutshell, it's a grant-funded program through the Small Business Administration, the University of Laverne, and the Governor's Office of Business and Economic Development with a very simple mission. And that mission is to help business owners just like yourself either get started or grow. And we do that largely two ways, I always say. Workshops and webinars throughout the year, just like today. Favorite topic, small business funding. But then we supplement those workshops and webinars with free, yes, I said free, one-on-one consulting, where you can sit down and meet with a business consultant to talk about your business one-on-one and what it's going to take to move the needle for you. So we want to make sure we get your questions answered. So a little housekeeping as we get started today. That's going to be, we're on a webinar, so everybody will be by default placed on mute. So we cannot hear you, but we want to get your questions answered. So we encourage you to use the Q&A feature down at the bottom of your screen if you're joining us on Zoom today. And if you're watching us on social, please use that comment feature because Joshua and Sophia on our team here at the SBDC are going to be helping us moderate those questions because, well, we want to share great information and we want to get your questions answered. So I have an ask for everybody watching today is please don't be shy, because if you're thinking that question, someone else out there probably is as well. So be brave. Get those questions into the comments feature on the social media or in the Q&A feature here on Zoom. But one of the first questions you're probably wondering is, hey, Sean, can I get a copy of those slides, those awesome slides that we're going to cover? And the answer is yes. We're going to send out a follow-up email to everybody who registered for the webinar with a link to the PDF of the slides. And the second question we always get that I'll hit right at the top is, will this be recorded? And yes, we're streaming this. So immediately following our webinar, a recording will be available in case you have to scoot to take care of some business. We've got you covered. So with those housekeeping items out of the way, we like to get right to it. Let's get to business. And today we have a great topic and an even better speaker for you today. And she is a loan officer with CDC Small Business Finance, which is a big partner here that we work with at the SBDC program. She's a loan officer, and in that capacity or in her role, she helps business owners access capital and understand what it's going to take to finance their business. But what I'd say I like most about our speaker today is she's really willing to help. She's willing to listen to your story. And if she can't offer you the financing through her program, she's really well connected into the community to help you better understand why maybe she can't fund, but also connect with other organizations who may be of interest to talk to. So without further ado, please welcome the one and only with CDC Small Business Finance, Iman Cotton. And the crowd goes wild, Iman. Thank you so much.
Thank you so much, Sean. That's exactly what I was thinking in my head. Thank you again. Thank you for allowing me to speak and share information. I am elated to share information. I actually come from traditional banking. I used to be a branch manager, a small business banker, vice president relationship manager, and even a credit manager on the subprime side. So being with CDC, and I'll get into what a CDC is or CDFI, has been so fulfilling and rewarding for me because I can truly help clients. I used to be one of those bankers, and I used to say shame on me, but knowledge is power. And I even talk to bankers now who are more mature and has been, very seasoned, who has no clue about CDCs and CDFIs and our ability. So that partnership with the traditional financial institutions has been invaluable. And as I mentioned, just the knowledge and being able to truly help clients, business clients now, unlike my ability to help when I was in banking, just because of different reasons, and I'll get into the differences, has been very, very, very rewarding and fulfilling for me. And then, like you mentioned, the partnerships with, like for instance, the partnership that I have with your SBDC and the technical assistance that you provide, and just everything, just the resources and the other organizations. When I can't do something, I'm elated to
I
share.
always say it takes a village, and
Yeah,
to raise a child. Well, it definitely takes a village to also
exactly,
support a small
exactly.
business. So
So
many hands
as,
make light work.
as
Definitely.
you mentioned, I'll get right into it.
And I'm
Um,
gonna put your contact information into the chat and Zoom as well, and on our social, so people can connect with you, have that information,
Please
because
do.
I'll turn it over to you, and we'll be feeding questions as we go. So get those questions into the Q&A. Don't be shy again. All right.
Exactly, and that's what I was gonna say. Like Sean said, please ask questions away, guys. So we are seeing the slideshow, okay, right? Perfect. So what to expect when applying for an SBA loan? I'm going to be giving you tips to know before you apply. And again, as Sean mentioned, I'm Iman Cotton. I'm a loan officer with CDC Small Business Finance. Today, I'll just do a brief introduction, discuss the different types of loans, the 5 C's of credits, our different loan products, and share a few success stories. Please feel free to drop a question at any point during the presentation, and Sean will go ahead and feed it to me. What is a CDC? A CDC is a certified development company. CDCs are certified by the SBA to administer SBA 504 loans, primarily for commercial real estate and other loans, other SBA loans. CDCs are private, nonprofit entities with a mission to provide financing to those who aren't quite strong enough for bank financing. My biggest goal is to get you guys bankable. We work with several different type of businesses at different type of stages. And the goal, the biggest goal is to be able to pass you back to your financial institution to possibly refinance the loan or to continue to expand on your lending products. There are over 260 CDCs in the country. As it pertains to like lending, the speed and risk impact the rate and the terms of the loan. Our loans are fully underwritten. So anytime that a loan is fully underwritten, it can take up to 6 to 8 weeks or 30 to 45 days. When the loans are low doc or no doc, those loans typically will go quicker or fund quicker in general. But keep in mind, any fully underwritten loan will be about at least 30 days. Not all SBA lenders are the same, guys. Each lender sets their own lending appetite, the credit box, and an internal credit policy, such as the minimum FICO score, collateral requirement, length of time in business. So the SBA has the standard operating procedures that we all have to actually adhere by, but we all set our own lending requirements. So that's why you can apply to one lender and possibly get denied, but get approved by another lender, because each lender sets their own lending criteria, and the SBA simply funds the deal. So the SBA isn't necessarily giving the approval, each lender is doing the approval. And that's why you should be conscious and make sure you're aware of the lending requirements when you go to apply somewhere. And I'll get into like startup businesses, existing things of that nature, but keep that in mind. When you want to apply, make sure that you understand what type of applicant they're looking for. For instance, if you're a startup business, you might not necessarily be able to go to the bank, but as a financial institution, we can never deny you from applying. So keep that in mind to make sure that the lender can actually meet your needs before you even apply. The types of loans, they're term loans, which are principal and interest payments over a period of time, such as an auto loan, such as maybe like a furniture loan, if you were to get one, just anything that's a student loan. Those are all term loans, principal and interest payments paid over a period of time. Line of credits. Line of credits are great if you don't necessarily know how much you need to borrow, but you want to have access to that emergency capital in the event the roof falls apart. So with just a line of credit is basically like the same thing as a credit card. You can usually access it through a check. You can do a cash withdrawal, and sometimes you even have a card associated with it. But the great thing about lines of credits are you only pay on what you borrow. So you can have 100,000 available, but if you don't touch it, you owe nothing. And then there's also merchant cash advances. I used to work for companies such as like First Data and Heartland, or Clover, if you're more so familiar with that name. If you accept debit and credit cards, you can probably get or apply for a merchant cash advance. And what they do is they lend based off your receivables, and they collect a daily amount based on your transactions. They collect a daily amount as your repayment. So this is not technically a loan. It's a merchant cash advance based off your future credit card payments. So they basically look at your merchant statement and determine how much that they are comfortable with allowing you to have as a cash advance. So those are the three different types of loans. At CDC, I currently only offer the term loans, but nevertheless, traditional financial institutions offer the line of credits, and traditional financial institutions and merchant payment companies offer the merchant cash advance. Use of funds is huge. Depending on how you use the money will also determine if you get approved or not. You can use your funds for business acquisitions, equipment, refinancing debt, working capital, or even for startups with tenant improvements and tenant improvements and construction. Again, the SBA Statement of Procedures, SOP, and the lender's credit policy or credit box will determine the rules and willingness to lend for a specific use of funds. So for instance, CDC Small Business Finance, we don't necessarily have an appetite for trucking, depending on what type of trucking it is. So I typically refer out for trucking unless it's for maybe like working capital or maybe we won't allow you to purchase a truck in the trucking industry. So, and again, but then I refer to other SBA lenders who will allow you to purchase, who will allow you to use the funds to purchase a vehicle or purchase a truck. So each lender is different based upon their appetite.
Hey, Iman, do you mind if I jump in on that? Because
Sure,
I'm taking my notes feverishly here, but I like what you said is, not all banks do the same thing. Can you talk a little bit about how, because I'm sure we have some banking partners that are also on the line today. Can you talk a little bit about how you work with other banks in that regard?
Absolutely. Chase has a huge initiative right now where they're helping businesses they're providing businesses like technical assistance, help with just overall strategic planning and things of that nature. They will do the lending themselves. Of course, that's every lender's preference. We want you to work with your bank. We want you to work with your bank and financial institution because you'll have a better rate probably, and you have the relationship with them. So you want to continue to build on that. In the event your bank can't assist you, we want to be as CDCs and CDFIs, we want to be the referral partner for them to present the profile, and we allow them to know, yes, I can definitely help them, or no, this doesn't fit my appetite and things of that nature, as I was discussing before. So we definitely have close relationships with a lot of the financial institutions because most of them can't work with startups. If they have challenging credit, they send them back to me. If they don't necessarily cash flow, they send them back to me because, again, each lender, regardless if you're a traditional financial institution or CDC or CDFI, you have different requirements and a different appetite.
And I think it's important for folks on the line to know that you're not like a bank that's going to carry your deposits. You're doing straight business loans, like term loans that you mentioned.
Absolutely.
Yeah.
CDC, Small Business Finance, we only do business loans.
Mhm.
We happen to be the #1 SBA lender in the nation for the 504 and the Community Advantage Program. Sorry for throwing it out there. It's just the facts.
Very active, guys. That's why we have you. That's why we partner, because yeah, you're very active. And I think that's also important to know about
Absolutely.
CDC. I'll do the plug. You're very highly ranked on 7A and 504 in the Los Angeles district and probably beyond. So
Yeah, for sure,
in
for sure.
terms of
But even still, I still partner with those other. We're not going to approve everything. It's it's not that everybody is having the same struggle, but it's the same credit box for everybody, and we're not going to necessarily have the appetite for everything. So I work with other, CDCs like Accessity or PCR and different places like that to refer if I can't if I can't assist you.
Now, I got another question, and I'm sorry, I'm not kidding class. Front row, answer, throwing up his hand
I
every
love
time.
it. I love it.
But I think it's really important with that slide you showed there that had the speed and the
Yeah.
time frame. I think it's important for folks to think about that because not all lenders are the same. What would you say are things to look out for? Usually I'll tell folks, daily interest rate versus APR, kind of understanding that calculation. But when they're looking at loans, sometimes you get these letters in the mail that says like $500,000 unsecured and all this stuff, and you're like, but
Exactly.
what do you usually tell folks? Just these are some of the things you should look into.
Absolutely. Just as I mentioned before, make sure when you're actually receiving all of these notices in the mail, you've been pre-approved, you've been pre-qualified, guaranteed 10,000, whatever it may be. Do your research. Do your research and understand what they're looking for to qualify you. And just because you receive a pre-approval or even a pre-qualification from me doesn't mean necessarily you'll reach the actual final approval because other things have to be checked and inspected. So the biggest thing is, like I stated, make sure, for instance, if you need to know if your bank works with startup businesses or if you can apply at 6 months, or if you need to wait for 2 years because you need 2 years of tax returns and financials, specifically what you were asking about. Low doc and no doc for those loans that are like 2 weeks, a week, or, please apply, you'll receive this, really quickly in 5 days. Those usually are minimum forms. They are either, no FICO requirement, and you have to submit some business financials. With our loans at CDC and most of the CDCs or CDFIs that I work with and the traditional banks, these are fully underwritten loans, meaning that we need tax returns. We need at least 2 years of your business tax returns, 1 year of your personal tax return. We need to see interim financial statements if you're an existing business. If you're looking to do an acquisition, we need to see 3 years of the seller's returns. And then sometimes fully underwritten loans have FICA minimums, such as those traditional financial institutions where you may need a minimum of a 640 or a 620 or 670. So that's the difference. And that's what this slide was specifically about. And thank you for that question. So I can actually go into like the difference between a fully underwritten loan and maybe one of those quick mail flyers where you just put stated information. Whatever you state, they'll take.
Yeah, I think it's important. A lot of people, I need a loan, I need it yesterday. It's like, whoa, 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 we got a plan for this financing.
Absolutely.
Yeah.
And we'll
But,
also get into that as well as far as planning for the actual financing.
and last question, and then we'll go on, I think, to the 5 C's, which is going to be good. And you talked about use of funds. is there any comments you'd make about like ineligible use of funds? Like we always get the question like, oh, I want to buy this house and flip it.
Exactly.
So like a passive investment. Any other common ones that you're seeing in terms of like, yeah, that's just not what SBA.
Absolutely. Like, we don't necessarily like passive income businesses. So like you stated, we're not going to allow you to acquire SBA loan for a home. Or we're not going to necessarily, so we're pretty standard as far as the industries that we work with, like adult entertainment,
Can't do
marijuana
that.
industry, things of that nature. We won't work with any of those industries, but as far as like the use of funds, specifically, as long as it's for like working capital, equipment, inventory, operating expense, refinancing debt, as long as there's a tangible benefit to refinance that debt. We won't allow you to take debt that's only at 6% and put it at 12%.
Mm,
So debt refinance and
got it.
acquisitions. But we, as you just mentioned, we won't give you money to go buy a personal vehicle.
Mm,
Unless it's like a cab truck or something that you'll be using to haul the equipment. So basically anything for personal uses or that can be deemed as personal use, you probably won't get approved with that request.
okay. And it looks like we have a question coming in. I said the last one, I apologize. We
Oh,
got a question
perfect.
from LinkedIn. Josh, do you want to field that one for us?
Sure. Hold on a second. Let's see what we got here. No questions. Oh, here we go. So does every bank need no docs?
So most banks, and again, as I mentioned, I've worked with like Bank of America, Citibank, City National Bank, Fifth Third Bank, most bank, every bank that I've worked at prior to kind of like the bottom falling from the floor on all of us back in like 2008 when they were doing no documentation and just stated, most banks at this point need full documentation. So they at least, so if you apply for a credit card, sometimes they'll ask you for the pay stub, or sometimes maybe not. But for an SBA loan or a SBA express line of credit, it's full documentation per the SBA statement of procedures.
Perfect. All right. So that's all our questions for now, but everybody get them into the chat, and we'll take another pause in just a little bit.
Okay. Good deal. The 5 C's of credit. I'll go through each one of these individually, but there's capacity, capital, collateral, conditions, and character. And again, like I stated, instead of going through each one now, I want to dive into each one individually. So the biggest one of these 5s for me is truly capital. But here's the thing. If you don't meet the conditions, we won't even get into a conversation about the actual capacity. So if you don't have 2 years industry experience in the business that you're looking to start, or the business that you're looking to acquire, of course, if it's an existing business, no problem. You have at least 2 years of experience, because to be considered an existing business, that means you completed 2 years of business tax returns. Not that you've just been operating 2 years, you completed 2 years of business tax returns. Because sometimes you could have started the business in 2018 and then the pandemic hit. Well, let's just say 2019, and the pandemic hit. So you really didn't start operating until 2021 or even 2022. I'll look at you as a protracted startup business at that point. Like, yes, you did incorporate in 2018, but you technically didn't start the business until 2021 or whenever it may be. So if you don't have 2 years of business tax returns and you were not supposed to complete 2 years of business tax returns, then we'll consider you as a protracted startup. But if you've earned revenue, let's just say you started 5 years ago and you've earned revenue each year, but you just chose not to file, we won't accept that. If you earn revenue, you have to file your business tax returns. If you don't, then we don't expect you to. So For me now, conditions is my first biggest 5C. Because again, if you don't meet the industry experience, if you don't have the actual skill set or the wherewithal or the knowledge in the business that you're looking to be in, I can't even review your financials. So again, conditions is one of the biggest fives. I'll start with that as the most important. So what experience do you have in you or any of the other business owners have in the industry? If you don't have direct experience, who will you hire? How will your skills and abilities allow you to successfully operate the business? How does the current economy affect your industry? And then does your lease, or do you have a lease that determines, does the location matter, basically? This is my biggest C after we get past conditions. Cash flow is totally king. This is all that really matters. Not all, but this is what controls everything. As Sean mentioned, with the CDC or with CDFIs, we want to understand your story. That's our purpose. We're there to help access capital to people that can't walk into traditional financial institutions. So cash flow, in addition to your story and conditions, is extremely key. Capacity. Business income, profit on recent tax returns and interim financial statements, projected income. So for an existing business, we want to see 2 years of business tax returns and interim profit and loss statements and balance sheets. For a startup business, we actually will 50% of our loans are given to startup businesses.
Wow.
Projection based.
Nice.
So
that's awesome.
That's awesome. It's like,
right?
50% of our loans, not just because that's the percentage that we deem that we want to do. It just happens to be 50% of our approvals are typically are for startup businesses, projection based. Because with us, you only need to be able to, as a startup business, we need you to simply be able to cover your personal expenses. For $1, we need $1, and that's called debt service coverage. Each financial institution has a different coverage ratio that they look for. Again, ours is only 1-to-1. Some traditional banks have a 1.25, 1.5, 2, meaning for every $2, I'm sorry, for every $1 that you borrow or that you have, they need 2 to cover it. We only have 1-to-1. So as long as you're able to cover your personal expenses, we will give you the business loan as a startup up to $350, simply based on your projections.
So you're basically trying to, you need to be able to show you can cover your personal expenses.
That's it.
As well as the loan that you're asking for.
Not as a startup. For an existing business, what you just explained was the global coverage, meaning we look at the personal and the business, and the business or your personal income needs to be able to cover your personal and business expenses. But when you're a startup, we only need, with the income that you have currently coming in, for you to be able to cover your personal expenses. And based on those 2-year projections that your team helps us complete, we will give them the loan simply based off of those 2-year projections.
Oh, thank you. Because I always assumed it was kind of historical and that it was an exercise to go through.
Not for a startup business, not for a startup, not with us on a startup. And I'll go ahead and pause for a couple questions.
Yeah, I think I just got in the chat. Looks like Josh does have some questions on LinkedIn. Josh, do you want to I know you're handling a bunch of different streams. If you want to chat them in, me or
No,
if you
that's okay.
okay.
We have one question from Catherine on LinkedIn. What information would someone need to bring to the bank to apply for an SBA loan?
Perfect. And I'll get into that towards the end, Catherine. And then also, we provided my calendar link. I would love for all of you to schedule a 15 or 30-minute call with me. And I can, and please in the notes, mention that you came from this actual webinar, and I'll go ahead and send you specific detailed information on the application process and things of that nature. But I'll get into it briefly towards the end of the presentation, Catherine.
Okay, and then we do have another question from
Okay.
Jeffrey asking if they have a tax return done for their business in April. He just started making money for the business. Will that be considered for cash flow?
So it sounds like you're still technically a startup, but yes, it will be considered for cash flow because you have started making money. And hopefully that would be a good thing, and your expenses aren't that high as well. But nevertheless, yes, because you have started making money, that would be your interim profit and loss statement that we will actually look at. So regardless if you're a startup or an existing business, if you started earning revenue, then we will want some type of financial statements just to get a gauge of where you are. But if you're a startup, we'll still look for that financial information, but we still will base it on your projections. So,
Okay,
yep,
that's it for now.
I think
perfect.
we have one from
Okay.
Zoom. Sophia, do you want to handle that one?
Yes, we do have one question. Someone is asking, can a 9-to-5 employee starting a business on the side apply for a business loan?
I love 9-to-5 employees. Okay. Let me tell you why. So as a startup business, the biggest question is, how are you going to cover your personal expenses? If you're a startup business, I still have to put some type of income in there. If let's say, for instance, you decided to walk away from your job in 2022, and now you have no income in 2023, and you're trying to start a business. It's a worse situation. Well, I can't cash flow that with no income.
Mhm.
Unless you have a reserve, or unless you have a savings account that you can show, or that you can just state, I have this much, when you do a personal financial statement and you write 100,000 in your savings account, we understand that, and I can cash flow that 100,000 based on you not having income. But if you quit your job and you have no income, and you have no one that can gift you funds, and you have no savings account, I have no income to put on your application. So therefore, you wouldn't be able to cash flow. So I stated I love working with those that are still employed, because you typically cash flow as a startup business because you have the income that should be already covering your personal expenses. Within that, we want to know that the income will continue. Meaning that you'll walk away from your job. You'll walk away from your primary income once the business, or after the business has made a turn to start supporting your personal expenses. So it's extremely hard, to cover unless you saved up, you have funds that can be gifted to you, you have family support or spousal support. The biggest question is, how are you covering your personal living expenses currently? And then the answer sometimes with startup businesses, well, I've started a business. And my reply is, well, your personal expenses are currently $3,000 a month. How are we covering this $3,000 a month? And again, as long as it makes sense, it makes sense. You've either saved up, you've been gifted funds, your spouse, you have spousal support, or your expenses are like minimum. So Yeah, so
Yeah, like you own your own home outright, or maybe you don't have rent, because I know rent's the biggest person
exactly,
living,
exactly. If you
especially here in
don't,
Los Angeles.
exactly, right.
Yeah.
If your spouse is paying the rent, but if it's a mortgage and it's on your credit report, we're going to, charge you for the mortgage. But even if you could show support that someone's paying half, then we'll accept that. That's the difference in like traditional financial institutions and CDCs or CDFIs, that we can look at the total picture and say, okay, well, I see this person is paying 1,000, this person contributes 1,500, and this person pays 2,000 on a mortgage that's 7,000. And then we'll, look at that and reduce the amount to just what you're actually paying. So I love working with people that are still employed because you guys have verifiable income. We just love to hear that income will continue until the business turns and starts making a profit.
And Sophia, I think, do you have any other questions before we
I
move
think
on?
it's one in the Q&A.
Yes, we have one other question. Someone is asking, if you are currently receiving disability benefits as a form of income, will that hinder the possibility of getting a business loan?
So in the slide, personal income, other employment, other businesses, spousal, military. If this disability income will continue, then I will count it. If it's just income that won't continue, then no, I can't count that.
Okay. Good question. Yeah.
All
Keyword
right.
continue. All right. Well, let's
Next week.
continue on with the presentation.
Capital. We require a 10% injection as a startup business or for a business acquisition. So the capital funds, the capital is the funds the business owner will invest or will inject in the business. The sources can be from a savings account, a home equity line of credit, partner contributions, family and friends gifted. That's what I was speaking of before. If you quit your job, as long as you can be gifted funds and those cover your personal expenses, then it's okay. So startups and acquisitions, 10% injection required. The great thing about that is, for instance, I have a franchise. I'm working on a startup franchise currently. They paid a $25,000 franchise fee back in January 2020. January 2021, but literally they're just now able to kind of get the location and things of that nature. Their loan amount is $250,000, so I need a 10% injection from them. They've already invested $25,000 for the franchise fee. Since it's a larger dollar amount, even though it was older than 6 months, I can count that as their injection. So for anything that's been as a startup or anything that's invested in the most recent 6 months in cash, that's what we can use as your injection or the capital that you put into the business. A lot of startup business use credit cards or even lines of credits for a lot of the inventory equipment cost. We need to just see that credit card had a cash payment to it at some point, because the injection has to be a cash injection. It can be credit, but we just need to, like I stated, see the actual cash payment for that credit card or whatever amount that you actually injected. So the biggest thing, we want to see that you've invested in yourself before we invest in you as well. So just keep that in mind, but we only require a 10% injection. At some places, most places it's 15% or 20%. Character is personal credit, is like credit score, payment history, percentage of revolving debt, length of credit, types of credit, revolving and installment debt. That's what goes into your credit score. Anyone with 20% or more ownership in the business will have to be a guarantor on the loan. With CDC, we will take a spouse of the business, and we will even sometimes take a co-signer without them being on the actual loan. Without them being an owner of the business. So the signers and the situations just have to make sense. I'll stop for a really quick question that I just noticed. Sorry. Can I get a loan to purchase a business that is already running? It will be a business transfer, but I am not employed at the moment. So what you just explained is a business acquisition. And yes, you can do a business acquisition with CDC. We work with, we handle startup loans, existing businesses, and acquisitions. But the piece on I'm not employed at the moment, I would just need to understand how you're covering your personal expenses. Do you have some type of large savings account? Have you been gifted funds? Do you have a spouse that's been, handling all of the expenses, things of that nature? So I'm not going to slam the gavel on no. It could be possibly yes. So, and I'll keep going. So character, personal credit. Anyone with 20% or more ownership has to be a guarantor on the business. And character goes into like credit score, understanding your credit score. What actions hurts credit score? Missing payments, closing credit cards out. Now you might say why? If the more available credit you have, the better impact it has on your overall credit score. So for instance, let's say you have 3 credit cards with a $10,000 limit. One of those cards has a $5,000 limit, and your balances on all 3 together is $2,500. So we're at $2,500 as your balance. The 3 credit card totals limits is $10,000. So you're technically at 25%. You would do 2,500 divided by 10,000. You're technically at 25% as a revolvers utilization ratio. You want that revolving utilization ratio to be at like 30 or 35% at worst or lower to have a great impact on your credit score. So again, 3 credit cards, all limits together, $10,000. The current balance is $2,500. Let's say you decide to close that card out for 5 that has the 5,000 limit. What you've now did was you made your limits 5,000 and the balance is still 2,500. So now we're at 50% revolving usage versus 25%. And again, I mentioned the number of 30 to 35%. Now it's kind of pulling down your credit score versus uplifting it. So keep that in mind. Opening up numerous trade lines in a short period of time, having more revolving loans and installment. You just want to have a blend of credit. You want to have installment debt, revolving debt, things of that nature. What doesn't impact credit? Income, length of residence, length of employment. What makes up the credit score? Payment history is 35%. Capacity, there goes that capacity is king thing again, 30%. Length of credit, how long have you had credit? Did you just start establishing credit, or have you had credit, or did somebody maybe add you as an authorized user when you were 18 or 17, to start helping you jumpstart things? So length of credit, search and acquisitions for new credit is 10%, and type of credit is 10%. The inquiry thing, guys, now. Inquiries have changed. So for instance, when you used to go to a car dealership, if you applied to 12 car dealerships and, in 5 days, they used to count that as 12 separate inquiries. Now, and please Google it for yourself also. Now, depending on the type of inquiry and in the time frame that is done, they don't have an impact of 12 separate ones versus just one. So Google it, like I said, for yourself, the inquiries. So if you're shopping for a mortgage, and it's kind of like, well, and I'm glad they updated this because it kind of made no sense. It's like, how do I know I'm getting the best rate if I don't submit a credit application? I have to apply to know the rate that I'll receive, and I want to make the best decision, but then I don't want to bring my credit score down by trying to get the best rate. So I think that's why they actually changed it it's like within a 7-day time period. If you are shopping for a specific type of credit and it's the same, it's different if it's a mortgage and an auto loan and a credit card. Those are the 3 different things. But if it's all like mortgage lenders, they now look at that differently. So approximate credit to wait for each year. So the longer you have credit, the better, the longer you have credit, the better it is, which is why I mentioned things like adding authorized users when your children are younger and things of that nature. How to improve your score: pay down your credit cards, revolving utilization. Don't close credit cards because the capacity may decrease. Continue to make payments on time. Slow down getting new loans unless you need them. I mean, if you need a loan, you need a loan. And then if you can do debt consolidation to move things from revolving debt to installment debt, that also is helpful sometimes, but not if you're going to do debt consolidation for 10,000 and put it on a loan and then go run that credit card back up to 10,000. So that's what happens often because life happens for us, but just be mindful.
I want to throw in a quick question because, reminded when my wife and I went to go buy a home and, you have two different scores.
Yes.
We're in the circle of trust. I know we're online right now, but she had a better score than me. I'll just put it that way. I had to improve mine. Yes. But I remember the bank telling me, well, we'll kind of average the two. If you have a husband and wife or a partnership, do you kind of do some sort of averaging of the score? If you have one person who's got great, one person's got, not so great, like.
I have a whole spiel of scores, so we're gonna wait and hold off on that one because I have a mic drop moment on the credit score piece. So,
all right,
Manny, your business should have a EIN number and state tax IDs before. If you want to apply for a loan, if you're not a sole proprietor, then yes, you should have some type of formation documents and a tax ID number or EIN in place before you apply. Or you can apply for like your EIN number, you can get immediately. Like if you go to the IRS website, they'll spit that out as soon as you actually apply for it. But as far as the business formation documents, that'll take a little more time. Now, if you've already applied, but you're still just waiting, I would say just submit the application because it'll take 30 to 45 days or 6 to 8 weeks anyways. And as long as that business documentation has been filed before we actually go to fund the deal, then we're good to go. So it's basically like things can be working at the same time to not slow down the process. Collateral. We do not require any collateral for any of our loans. We do a UCC filing on the business assets, but we don't require any type of collateral. And collateral is tangible assets that can be sold by the lender in the event that you default on your loan. The statement of procedures requirements are based on loan amounts and use of proceeds. The statement of procedures for loans over 350, not for real estate, must aim to be fully secured, but my loans go up to 350. And again, we don't ask for any personal collateral. Common forms of collaterals: personal residence, business assets, personal assets, and then loan to value for collateral even matters, but it's more so just a SBA requirement that we have to put in place. But nevertheless, we don't require any collateral. We will do a UCC filing. Credits, go for it.
Okay. No, I'll wait. Well, actually,
you sure?
For collateral, I think I wanted to bring up, I've seen a schedule of collateral before in some loan. So not all collateral is equal, like tenant improvements. I was working with one client recently who had a lot of tenant improvements. Would you count tenant improvements as collateral? And if so, it's probably not going to be dollar for dollar. It's going to be some sort of discount. So can you kind of talk about like how collateral is looked at from a discount rate, I guess? I don't know how to phrase my question.
So collateral in general, with us, like I stated, we don't really have, besides a UCC filing, we don't have any collateral requirements.
Okay.
So, and one of my senior loan officers, she makes a joke that we're the first to, take the table and chairs, but we don't have a collateral requirement. But in either event, like personal residence, if the property has equity when valued at 85% of the present value, business assets, which are all inventory and equipment owned by the business. So if it's tenant and improvements, that's just, you know, a bid and a contractor that's going in to, and it's nothing to really secure. It's no like tangible asset with the actual tenant and improvements. With construction, no tangible asset with that either. But equipment, that's a different story. So if you want to pay a refrigerator, that's an asset. You know what I mean? So but anything that the business basically owns as far as inventory and equipment is considered are considered business assets.
Okay.
Did I
And
answer?
yeah, it definitely does. And one other question I wanted to bring up is in these 5 C's of credit, I gotta ask, how important is the business plan? I work with a lot of clients that kind of say, you know, well, I think about my mother who would always jokingly say, Sean, my business plan is simple. It's to make money. Why do I need to write it down? Where would the business plan fall, and in your opinion, in some of these 5 C's that we've kind of gone through?
I would say it is within conditions maybe, but also within the character. Well, conditions more so. Conditions, because the business plan, I think is extremely important, especially if you're a startup, because it tells us that's what I'm presenting to my credit officer to approve the actual loan. You know, I'm getting the management information from the business plan. I'm getting the competitive analysis from the business plan. I'm getting the expansion information from the business plan. I'm getting what you sell from your actual business plan. And from your business plan, I can see that you're abreast of your business and you've sat down and you thought about this and you figured it out. And those financial projections for 2 years, they're also key, extremely key if you're a startup, because that kind of determines what your monthly operating expense is, which will help us gauge what we'll give you for working capital. So the business plan is extremely important, and I appreciate when they're more thorough than not. But if it's a simple business, a simple plan, it's pretty cut and dry, then no need to, you know, try to fancy it up.
Yeah,
But
make
we
it hard
just
to mess.
exactly, but we do need the, you know, basic information of the market analysis, management summary, you know, what you sell, expansion, use of funds, like, you know, an overall plan.
Thank you. I was curious to get your thoughts on that.
I will add to that. I don't mind at all a client calling me that's already has a business that's, you know, the business name and EIN number, that's a startup that's looking to apply. I always refer them back to you guys for that business plan and projections when they call me. But at the end of the day, if you don't cash flow capacity, if you don't have the capacity, your business plan matters. And I want you to go through that exercise, and you need to create it because you need to understand your business and have a sales plan to finish at the bottom line that you want to finish at. But at the end of the day, the overall the overall plan and the numbers are extremely key. So yeah.
No, thanks. Sorry to throw that one at you. I was just curious because we do a lot of the business planning and it's a great exercise, but then it also, like you said, it comes back to, okay, capacity, you know, cash is king and cash flow is queen. And well, how
and I'll still try to cash flow a deal while you're working on the business plan and projections for that client. Most times you need to know, of course, the loan amount and the payment amount so you can add that in the projections. But sometimes I don't even know the loan amount because they haven't figured out a business plan and the use of funds. So the SBDC, you guys provide invaluable help because you help kind of work through the use of funds, the, you know, and what you actually need to start the business. So, mic drop moment. CDC Small Business Finance. We have no minimum credit score requirement.
I'm sorry, I don't know what to do.
Right? That was fine. I loved it. So we have no minimum credit score requirement. with reasonable explanation. What we do have, we have a minimum SBSS score. And the SBSS score is the SBA predictive index score that the SBA set that basically looks at the likelihood of the business and the person to pay us back as a lender. The score is based on personal credit history of all owners of 20% or more. Debt to credit available is an important factor. Capacity, business credit history, impacted by the time in business, and then the risk level of the industry is how an SBSS score is derived. If this score doesn't meet our minimum requirement, then I still can help you if you're possibly in a specific target market, which I'll get to also. So we don't have a minimum credit score, but we do have a minimum SBSS score. Question. What housing and debt ratios do you require to qualify someone for a loan when you are looking at their personal cash flow? So we're getting into our guidelines and our underwriting policy, which is internal information, more so than what you actually need to apply. As I mentioned before, for every dollar, I just simply need $1. So I just need you to be able to cover your personal expenses and have some funds remaining, some personal discretionary income remaining after all of your personal expenses are covered. And that doesn't necessarily have to be $1,000, $1 million. It can maybe be 300, depending on your situation. So you just simply need to be able to cover your personal expenses, which we'll look at if it's a credit card payment. We'll multiply the $10 times 12, which is 120. If it's a, if we're looking at, we also look at your federal and state tax payments, but we'll take that total since it's an annual total versus a monthly. So we turn anything that's paid monthly into an annual amount, and we look at all the annual payments. Based on that, I need $1 for every dollar. That's the best way I can answer the question without just completely divulging my underwriting policy to you. So in reference to SBA 504, the 90% fixed rate, and we're just getting into the different type of loans now. With the SBA 504 loan, money can be used to buy a building, finance ground up construction, or building improvements, purchase heavy machinery or equipment. These loans are typically 125 to 20 million, fixed for 10 years for equipment, 20 to 25 for real estate. Down payment minimum is usually 10%. The SBA 7A loans. 7A loans can be used for short-term or long-term working capital, purchase existing business, as you mentioned, for the acquisition, refinance debt or equipment or CRE. Loans are typically from 50 million, actually I'll say 10 million to 5 billion, and the rates vary depending on prime. And I have an update just in case you're not aware. Prime increased from 7.75 to 8% as of today. So the prime plus, anytime prime moves, your rate on your loan will change. If you have a loan that involves prime plus something, those are always variable and they'll move only when prime moves, and we don't control that as lenders. Terms depend on the use of proceeds. It could be anywhere from 5 to 7 years, or 10 years, or 10 to 15, or 20 or 25, depending on if it's real estate, equipment, or working capital. We do loans. Reasons the bank may not fund a loan, but CDC or any CDC Small Business Finance or any CDC or CDFI will do a loan, maybe a startup business, early stage business, as I've mentioned before, like a protracted business you started maybe 17 months ago. The weak cash flow, weak collateral, credit issues, smaller dollar requests. With CDC Small Business Finance, I actually offer SBA microloans offered directly by CDC Small Business Finance and other approved micro lenders. There are several micro lenders out there. And then, Sean, before you send this out to anyone, and please let me be clear, we just determined that our rate for the microloan is 8.75. And you know what? Based on the rate change today, I'm hoping it stays 8.75. But we were running out of microloan money very quickly, but now we just got loaded up for the rest of the year. If I'm ever out of microloan money, I still have money through the Community Advantage. So when people call and say, hey, I want the microloan, my question is, do you need money or do you need specifically a microloan? Because if it's money you need, I always have money, but the microloan rate is only 8.75, but that loan only goes up to $50,000. So if you want 50,000 or less, it is a good idea to look at the microloan because the rates are much lower than the Community Advantage rates. The term can only be 3 to 6 years. There is no prepayment penalty for any for none of the products that I actually offer. Post-loan business counseling. We have business advisors that we require anyone that does a microloan to meet with after the loan is actually funded. And that's just to make sure that you're on track with your business, that everything's going fine, and it's a free service. Community Advantage loan. Again, this is what we're #1 lender in the nation for. Not only do I cover California, Arizona, and Nevada, but now we cover like 26 states because of our relationship with Momentous Capital being acquired by them. So the Community Advantage loan allows non-bank lenders to make SBA 7A loans. They're offered directly by CDC Small Business Finance and other approved alternative lenders. The loans, like I mentioned, we cover California, Arizona, and Nevada, but there's an additional like 23 states. If you have any questions, please just shoot me a message and I'll let you know if we cover the state that you're interested in or not. The loan range, 10,000 to 350. We offer these for startups, existing businesses, and business acquisitions, expansion, debt refinance, and CRE. The rate is prime plus anywhere from 4.5% to 5%. And the term can be up to 10 years. I always say, take the 10-year term if there's no prepayment penalty, because on paper, your payments are lower for a 10-year versus a 5-year. So on paper, it looks better depending on your income to have a payment of 500 versus 1,000. And it's better on your debt to income ratio. Is the microloan available in addition to a primary SBA loan from Momentous? So combine both to get the full amount needed. So can you do 350 from, and then Momentous is, you would only get the SBA loans from CDC Small Business Finance. As reference to having multiple loans, you can have multiple loans with us. I just funded a deal yesterday for 125 and they still owe like 89,000 on the other loan. But as far as trying to get, if you're looking for over 350, as long as your capacity can stomach it, then we might be able to look at a Community Advantage loan and then maybe a micro loan also. But worst case scenario, I could just send you to another lender after I do 350 and you can see what they can do also. Because you can have multiple SBA loans. It just depends on like the UCC filing and things of that nature. Impact loans. Remember I stated that we have no minimum credit score requirement, but we do have a minimum SBSS score. If that minimum SBSS score isn't where I need it to be, if you're African American, Latino, or if your business is located in a low moderate income area, I can still continue with the loan process. Usually your SBSS score isn't where it needs to be because you probably have collection items or you have credit issues. And as long as you're African American, Latino, or your business is located in a low moderate income area or LMI area, then I can proceed with the loan process. And this is only throughout California. Go for it, Sean.
I was just going to ask, in terms of knowing if I'm in a low to moderate income area, the business, did you use FFIEC map, or is there any kind of map that folks can kind of
That
check
is
out?
a resourceful map, what you just spoke, what you just mentioned, and maybe you could drop that in the chat for them.
I'll do that.
But you can also just, if you Google, is my business is in a low moderate income area, a site will come up which will allow you to put in your address, and you'll be able to see that as well.
And is it for the business or the applicant?
It's
Because
for
I
the-
might live in one city and have a business in another. Is it?
It's where the actual business is located.
Okay.
Yep. And then again, this is only throughout California, but again, if you're African American, Latino, or the business is in an LMI area and you have a lower than required SBSS score, then I can continue with the loan process. The unresolved credit issues just need to have resolution in place. So if you have open collection items, or if you have an open judgment, I can still, cash flow the deal and kind of gauge where we're at with things. And you can simply put a payment plan in place. And as long as we have documentation that there's some type of resolution in place, then we can proceed with your request. Fair enough? So if you have an issue, we require you to take care of it. If it's not yours, dispute it, file your police report, have some documentation proving that it's not yours. Help me understand the story of what happened. And then even if it's $5 a month, put some type of payment arrangement in place so we can have some type of resolution in place to know that you're taking care of the item. Yes, Sean.
I was just going to add to that. I think this is where,
Yeah.
disclose. It's important just to be upfront and honest. You got to have that relationship with the person you're working with.
Absolutely.
Because it's going to come out in underwriting. There's so much due diligence that the banks go through in the underwriting process.
Yeah.
So yeah, just be upfront. I guess that's all.
Absolutely. And being upfront. So the great thing about working with me or most of us is at CDC, we don't necessarily have to pull your credit up front. We'll pull the SBSS score, just to make sure it's worth both of our time. And if you're in the, target audience of African American, Latino, or LMI area, we can kind of figure out if we need to do the impact loan right away or not. But through the personal financial statement, I can get a gauge of all of your debts. So as Sean just mentioned, transparency. We need you to list each and every trade line that's reporting on your credit report, the balance, and the minimum payment. As long as you're pretty straight up with that, I can get a good gauge of your cash flow and won't even have to pull your credit until after I know things actually cash flow. But then if you complete the personal financial statement and you're not as transparent as you maybe should have been, when I do pull your credit, if I find $2,000 in extra payments that I didn't know about, then that could totally change the overall situation. I don't know if there's a way to specifically build up your SBSS score, but in either event, once you actually submit and this is a question from Crystal, but once you actually submit the application, that's something that we will be able to tell you what your actual score is, and it doesn't necessarily impact your overall credit score. So, but maybe I'll try to look it up, Sean, but nevertheless, Google SBSS score and can you build it on your own? But I don't know if it's something that you can necessarily, if it's not there, then I don't know. Well, let's take that back. Let me take a step back. So with your personal credit, it contributes to the overall SBSS score. If your personal credit is low, then your SBSS score will probably be low. So the kind of way to build up the SBSS score is to control what you can control on your personal credit, because the business credit, you probably haven't built it up yet if you don't have any loans out there. So I would say having strong personal credit will be the way to build up the actual business credit. Am I okay to field these questions really quickly, Sean? Yeah.
By all means, yeah.
Oh, okay.
I love to keep the questions coming, everybody. Yeah.
Anita asked, I asked about the business transfer not being employed. Okay, sorry. I'm looking for a microloan, 50,000. I'm in California, Latino. I have a savings around, blah, blah, blah. Should I try to apply for a loan? Anita, use my calendar link that is in the chat, and let's please have a 15 or 20-minute call, and let's, allow me to take some time to have a personal conversation So to learn more about your actual needs offline. Yep. And that applies to anyone. Before I get into success stories, were there any other questions?
Looks like we're all caught up with questions on LinkedIn, so you're good to go.
Okay. A few success stories. I had, for a business acquisition, we had a borrower that was purchasing a 20-year-old art studio. They actually went to the art studio as a kid and worked there after college and things of that nature. This was a complete startup, so they couldn't actually go to their bank. So they had actually a pretty good credit score of a 698, but we were able to do a loan for 157 for this person, 157,500 as a startup. They had pretty strong, she was an employee in the business, but no outside income. So the salary from the owner will now actually be their salary. So they had pretty strong income, but the time in business was the issue with this one as to why they couldn't go to their bank. And then also the capital, the capital was gifted, meaning it was given to them. And they use their savings as the post-funding liquidity, because post-funding liquidity means we just need to see that you'll have some money still available after we actually do the loan, which is key and important. So yeah, I'll just leave it at that. Post-funding liquidity. We need you to have post-funding liquidity.
That working capital. It's, you know, it's one of those things like, oh yeah, I need to have some money
Exactly.
to run.
I need to maybe have $100 afterwards just in case of this. Absolutely. So we want to see that you have post-funding liquidity. Working capital, the fund, it was for a startup, a home-based franchise. 100,000 was the project cost. The source just came from the internet. And again, because this was an actual startup, they couldn't go to the bank. They had a 710 credit score. We did a UCC filing just on the business assets. The cash flow was projection based. So we gave them 100,000 for a startup business based on their projections that they submitted. And then they also had 20,000 in capital, and they had a current job, W-2 job. So the use of these proceeds were working capital for startup costs and operating capital. The reason why they couldn't go to the bank again, because it was a startup company and projection based. We also had a startup rental company who needed some equipment. There's 65,000 equipment and working capital. And they had a 15,000 injection. The bank actually referred this deal to me. The credit was okay. We did the UCC filing. The cash flow, again, was projection based for the business, and they were actually able to purchase the equipment. That's when you speak of the business asset, whatever equipment that they purchased is what we would have put the UCC filing on, or the lien. They had great experience and good outside income. So yeah, guys, that was my presentation, and here is my information. If there are any other questions, I would love to answer them. And Sean, whatever you want to throw in there, please.
Yeah, those are really good case studies. I think it's because every business, every loan, it's kind of like a maze. Everybody's in a different spot. And I really like how you have a Calendly, so you can just have these conversations, because it might not be something I want to share in front of the world.
Exactly.
On a webinar.
Exactly.
So my credits, you know, but that's where every business is different. I love how you use the 5 C's to kind of use that as a broad umbrella for the strokes that go into the underwriting.
Sure.
And I guess I'll just give a plug for CDC Small Business Finance, how you're willing to listen to that story, because everybody has a story. Everybody has a dream. They have that story. And well, I guess we'll turn it over to questions to see if anybody's got any questions. We've covered a lot of information really fast. And that's why we're recording. So you can kind of go back through this and know that rates will change. So there's some stuff you saw in the slides today that will, you know, isn't fixed forever, you know, so keep that in mind as well. Because the environment today is changing. Let's be honest. I mean, we just saw the rate hike from the Fed yesterday. So it's impacting us all. And I think for me, when I'm working with businesses, it's really about planning for this access to capital. And thinking that through and knowing resources. So maybe I might not be ready to get a loan today with Iman or my bank, or but it's having those conversations, knowing what it's going to take, planning for it, so that when that opportunity does arrive, I'm not sure which word I'd use, you're ready to to address it or to capitalize on it, because business is inherently risky, let's be honest. And banking is all about managing risk or reducing risk. So there's an inherent, I won't say a conflict, but a conversation to have to be able to meet in the middle. And I want to give a big shout out to Noe on LinkedIn, because he was also with CDC Small Business Finance. He's watching us today. Thanks, Josh. Are there any questions on LinkedIn, Josh? Are we all caught up?
And I actually mentioned Chase Bank earlier when I first started, and the great program that they have currently going on with providing the technical assistance. So as I mentioned, I'm grateful for all the partnerships, and that's the purpose of working with us, is to get you guys bankable and send you back to your bank so they can refinance for better rates and things of that nature. So please, guys, make sure that you, if nothing else, use me as a resource. Really quickly, I'll roll through some of these questions that I see. Manny, what do you need to bring to the bank? Yep. So I don't know if I covered that, but nevertheless, once you reach out to me for the calendar link, I'll send you an actual email request of like the documents and the checklist. But generally, it's usually your most recent year business tax returns. If you're employed, most recent pay stub. If you're an existing business, we need we need 2 years of business tax returns. We need like your interim profit and loss statements and the balance sheets. We need, maybe if you're a startup, then we'll need that business plan from Sean, business plan and projections. If it has involved a lease, then we'll need a lease, non-executed, but we'll need a lease and maybe the bid for, tenants and improvement and construction, things of that nature. So it depends on if you're a startup, acquisition, or an existing business, the type of documents that I'll actually request. I think we answered the one about disability. How's it? I answered SBS. Sorry, Sean. I'm just trying to make sure I covered everything.
I was gonna say, Sophia, did we hit them all? Or are there
Now
other
I did.
ones?
Now I did. I think so.
You did? Okay. Well, we want to make sure we get your questions answered, and that's where the SBDC and CDC Small Business Finance are here to be a resource for you. But if there's no other questions, I'd just like to say from the bottom of our heart here at the University of Laverne SBDC, thank you so much, Iman, for being with us today to share these great programs and just kind of demystify this process a little bit more. And I also want to say thank you to Josh and Sophia on our team for helping us with the stream and handling all these great questions. But we do want to, I would be remiss if I didn't say, join us next time. We're going to be on April 27th, 10 a.m., where we're going to be partnering with Google, talking about setting up a website and a professional email. Very fun stuff. So hope you can join us. But until then, thanks for watching, and we'll see you next time.
Thank you.
Bye for now.